Hello everyone, welcome to Mr. Corp's channel, and our today's topic is shareholders and investors ratio. Okay, so here is a brief intro about me. Now quickly jumping into the topic. Now we are talking about investments into stocks and analyzing in the stock before making investing decisions, where to invest, not to invest, or already invested and deciding to where to pull back the money or not hold for a longer time or whatsoever. So these analysis can be divided into two parts. Okay, let's note it down. The first one is the fundamental analysis. The fundamental analysis. Okay, and the second one is technical analysis. Okay. Now, the ratio analysis is basically part of the fundamental analysis, and this includes evaluation of financial records, which are my books of accounts. Okay. Whereas technical analysis includes reading the trends, reading the trends of stock prices or volume. Okay. Now, our this video is dedicated towards the evaluation of the financial records because this is where the ratio analysis comes into picture. Now, when we are talking about evaluation of financial records, what we are trying to achieve here, before investing in an organization, we would understand the value of the organization. Okay, and once we get the value of the organization, then we will able to see whether the market the company is undervalued or overvalued. So that is the objective. Now, how to get to this thing? Okay, so when we are evaluating securities, we are trying to measure the intrinsic value. So what is our objective over here? First, measure the intrinsic value. Measure the intrinsic value. Now, what is intrinsic value? What is intrinsic value? Intrinsic value is basically the what is the worth of the assets or the stock. Worth of assets it should be net assets for company or stock price. Okay. Now, how to get to this? How we can find this? Now, one of the method is by discounting the cash flows. Okay. Now, a lot of assumptions and analysis goes into this. So one of the way is discounted cash flows. So cash flow analysis. And then we will get to know the valuation of a company. And there are different ways to get the valuation, and cash flow analysis was one of them. Okay, because this gives us a true picture based on the future prospects of the company, the projects in line, and whatnot. Okay, since we and the other ways based on the market price is one of the ways, and the book value is one of the ways. Okay, now let's come into the ratio part. How ratio helps us is to find and analyze the companies. And one thing we would say is like, don't use these ratios in isolation. And why not? We will see along the way. The first one is price to earnings ratio, also known as PE ratio. Okay. Now this is market price per share by earnings per share. Okay. Now how we get the earnings per share? Earnings per share is your distributable profit, or you we can tailor the ratios. Okay, so either distributable profit by average number of shares. Now, why average number of shares? Because suppose at the start of the financial year, an organization was having 10,000 shares floating the market. During the year, they issued more thousand shares, and then they did a buyback. And at the end of the day, and the end of the financial year, they were having, say, some 9,500 shares floating the market. Now, since the number of shares were changing throughout the year, so it is ideal to use the average number of shares in that case. And we need to use the weights, like for how many months it was this much, for how many months it was this much, and so on those. So average number of shares should be used. Now, what this ratio particular tells, it tells the investor uh, if a company is undervalued or overvalued in the market based on the earnings per share. So if the company is generating $1 per share earnings, and if it is market is ready to pay $10 for that company, it means it is overvalued by $9. Now, why such a valuation? Now let's note it down. The market price is say $10, and the earnings per share is 1. So for every dollar in the company, investor is ready to pay $10. Now, why that? Because this $10 investment is a one-time investment, and this $1 return will be for the foreseeable future until and unless the investors pulls back its money or company goes into losses. Okay, the scenario can change, but market is ready to pay that $10 now is because it believes in the future prospects of the company. Okay, so another important thing over here is the future prospects of the company. Let's note it down over here. Future prospects. Right now, if you see in the technological sector, companies who are making losses are also having market price per share much higher than other sectors. Okay, also making losses, but market price per share is high. Why? Because people believe in the future prospects of the company. Same goes for the green energy sector. Okay, because the investors believe in the future of the companies, and they expect that in future their investment made now will be worthwhile in terms of a higher return. Okay, so this is why there's a such valuation goes, and obviously the market is not rational. Yeah, so the next one is price to book ratio, and let's quickly note it down. The formula for this: same market price per share divided by book value per share. Now, how to get the book value? The book value will be my net assets, which is my total assets divided minus total liabilities. And the book value per share will be net assets divided by average number of shares. Again, the average number of shares will based on the same logic as explained earlier. Now, what this ratio tells us, so it basically compares the company's stock price to its book value per share. So if a company stops doing business, all its business right now, and it has to pay all its loans, and how will it do that? By selling all its assets. Now, by selling all its assets, paying all the loans, the creditors, and everyone, the preference shareholders, and all those things, then what is left belongs to the common shareholders or the equity shareholders. Okay, so that is the book value. Now, that amount divided by number of equity shares will give me a book value per share. Now, for every dollar in the net assets of the company, how much the market is ready to invest. Now, again, because the company believes that the market believes that the company will is having a brighter future, and hence they're ready to put in that much money. Now, again, this ratio should not be used in isolation, rather needs to be benchmarked against competitors and the previous year performances. Okay. Coming to the next one is return on equity. So this will be my distributable profit divided by average number of shares. Okay. Now, this tells us for every share how much the company is giving a return. Okay. But the catch over here is that this is profit. Profit will be, you know, let's put it the other way. Now, this is just analyzing equity. Okay. Whereas the funds provided to the company can also be in the form of debt, right? Now, this distributable profit might be increasing because of the influx of debt capital in the business, and the equity remains same. So in this case, the debt will increase due to this influx, production will increase, sales volume will increase, and the overall profit will increase. So distributable profit goes up, whereas this equity shares remain constant, right? So overall return on equity will obviously go up because the denominator is constant and numerator is going up because of the debt, because of the debt, right? So again, this ratio should not be looked into isolation. Rather, it needs to be looked benchmark, and the capital structure of the organization should also be taken into consideration, because this ignores, or the return on equity can be modified to return on capital employed, ROCE, which will, let's just write it down. This ratio can be modified to be used as ROCE, return on capital employed. Okay, return on capital employed, which will include both my debt, both my uh, debt plus equity. Now, this will give a better picture considering the whole capital structure of the company. Okay, now moving ahead, let's create some room for this particular ratio, dividend yield. Yeah. Now, dividend yield is also known as dividend price ratio. Dividend price ratio. Formula for this is dividend divided by P0. Now, what is this P0? The P0 is the initial investment, is the initial investment, and P1 becomes our current market price per share. Now, this tells that how much dividend we are getting, how much return we are getting. Now, the first previous one was distributable profit. Now, the whole of distributable profit is not always distributed, okay? Rather, a big chunk of it is retained. What is distributed is dividend. So, what actually the investors get in cash is the dividend, okay? So that is why this ratio becomes important, because from investors' point of view, they want their return. Okay, especially the short-term investors who don't want to hold the money for hold the investment for a longer period. They are in, they want to in cash and just make some capital gain, some dividend. So take some dividend and just sell the shares. So another ratio online with this is the capital gain. Okay, so how we calculate is P1, which is the current share price, minus P0, which is the initial share price. So suppose right now the share price is 212, okay, whereas initially it was at 10 when the investment was made. So how much return is it? Is giving 20% return on capital gain, and dividend is separate. So the total shareholder returns becomes total shareholder return is dividend plus P1 minus P0, the whole divided by P0. Okay, this is the summation of this ratio, and this ratio will give us this one. Okay, so this talks about the total shareholders return. Now, finally, the capital structure of the organization is also an important factor to be looked into, which is the debt to equity ratio. Now, debt to equity ratio can be calculated in two forms, either by debt by equity or debt by debt plus equity. Okay, and this will basically tell us about the capital structure of the company, whether it is leveraged, how much leveraged, and again, should not be judged into isolation. It needs to be looked upon from the industry, the sector point of view. What is the industry average? What is the competitors average? What is my capital structure? And how it has improved or deteriorated over the years. So all these factors need to be considered. So any of these ratios should not be looked into isolation, rather it needs to be benchmarked against the industry average or the competitors or the year on year performance of the organization. So thank you for watching this particular video, and do follow, share and subscribe.